We looked at the accounting equation, and that's just representing assets, liabilities, and owner's equity. So we say assets equals liabilities plus owner's equity. But that's not really a thing in business. We don't usually publish that. What we need to do is turn this accounting equation into a formal accounting business report. And that report is called the balance sheet. And it's going to be really important for the rest of the course. So the balance sheet looks like this. It's a big T. And on one side, we have assets. We're going to call that the asset side, which sounds quite obvious. It's only got assets on it. But technically, that is its name. And on the other side, we call that the equity side. And that doesn't mean owner's equity. Equities means liabilities and owner's equity, which is a bit weird. And it's all to do with the fact that this mirrors the accounting equation. It just means that everything you buy, an asset on the left, is financed through some type of equity, I guess we call it. It's either finance from borrowing, so you get it from someone else, you borrow money or you buy something and don't pay, or it's financed by the owners. So we call that the owner's equity side, and we can see it now. We have assets on one side equals liabilities plus owner's equity. So it's designed to mirror the accounting equation, and it can apply to a single transaction, the balance sheet. So let's just go back to an example from a previous video. You need $2,000 for a new iPhone, but you only have $500 in your bank account. So you go to your parents and say, I would like a $1,500 loan to buy the phone, and I will repay you at $100 per month. Well, on the balance sheet, we said the assets go on the left, so that would be the iPhone, which is worth $2,000. On the right, we start with the liabilities. You've got a loan to your parents for $1,500. And we've also got your owner's equity, which we call capital. Your capital or owner's equity in that phone is $500. And what we do with the balance sheet is then we total it up at the bottom. So we total up this side, 2,000 plus nothing is 2,000. 1,500 plus 500 is 2,000, just to prove that it does balance. And then we'll see it always matches the accounting equation. So we've got assets of 2,000, liabilities of 1,500, and owner's equity of 500. Beautiful. Now that was one single transaction. The balance sheet also applies to a whole business. Let's use another example we've previously done. Matt wants to open a business called Matt's Mechanics and needs $100,000 to start the business. He puts in $80,000 of his own money, which we call capital, and he borrows the other $20,000 from the bank. So we now have a balance sheet. In terms of the business's perspective, it now has $100,000. It got $80,000 from Matt and $20,000 from the bank. So we'll write cash at bank is $100,000. Where did that money come from? Well, that's what we're going to put on this equity side. We will say the liability is a loan to the bank for $20,000, and the owner's equity will be the money that Matt put in himself to give himself capital of $80. We'll total the two sides up so they balance. And this should mirror the accounting equation. Now, we also said Matt actually went and took that $100,000 and used it to buy some stuff. So let's get rid of the $100,000. Let's reset the totals. And what did he buy? He went and bought a garage for $50,000, equipment for $30,000, tools for $10,000, and some computers for $10,000. Well, that should still balance. So if we add 50, 30, 10, and 10, we'll get $100,000. And if we add 20 and 80, we'll get $100,000. So the balance sheet always has to balance, and it always has to mirror the accounting equation. So we look at that. We've got assets of $100,000, got liabilities of $20,000, and owner's equity of $80,000. So that balances. And what we say with the balance sheet, it's prepared on an as-at basis. We're going to use that term a bit. What does that mean? It just means that the balance sheet is prepared after a set period of time. Now in business, these periods of time can range from monthly. So that would be at the end of every month, we're going to do a balance sheet. So these little balance sheets here. But some businesses don't want to, it's a lot of work to prepare a balance sheet. So they don't do that every month. They do it every 3 months, which we call quarters. So that would be at the end of March, June, September, and December. Some businesses do it even less than that. If you're on the stock market in Australia, the minimum you have to publish is twice a year or every 6 months. So you have to prepare a balance sheet in June and December for the public to see. And some businesses only publish a balance sheet once every 12 months, say at the end of December, or more commonly at the end of June actually, because that's the end of the financial year. But the point is it's only once per year. And I guess what we could say is, well, what does as at mean? It's kind of like just taking a photo. It's just saying this, if you took a photo of yourself today, it's basically saying this is what I look like today. If you took a photo of yourself in 12 months, you'd say, this is what I look like in 12 months. So that's all a balance sheet is. It's just saying, here's what the business looks like at the end of today. But instead of your face, it's saying, here's what you own, here's what you owe, so assets and liabilities, and here's what the owner's residual interest in those assets, which we call owner's equity.